So today's agenda will be on lecturing chapter 3, and then after lecturing chapter 3, I will give you a take-home midterm for you to do. Alright. All things regarding briefing on midterm will be informed later on. Alright. So stay tuned and let's continue with the lecturing first. Okay, so on chapter 3, we will focusing on companies managing growth. Yeah, we're talking about how to financially growth as well as at the same time maintain the business growth as well. All right. So when we talk about growth, growth can be a subjective matters. Yeah, that means it can be any business growth. Yeah, it can be financial growth. It can be other types of growth. Yeah, even though companies' businesses are growing, however, they are not financially. They are not growing. This is what we call grow broke. That means sometimes they want to go big, yeah, but financially they don't have a very in financial terms they doesn't have any stable position. All right, I give you an example. Let's say if you want to set up a clothing business, let's say clothing business. Okay, let's say for next year you can see that the previously, yeah, the sales, let's say 1000, and then after let's say 1 year your sales is rise to 2000. Alright, and then you will have some aim of, let's say, you want to aim of 5,000 ringgit collection or sales, right? So at the same time, yeah, while you are targeting the sales from 2,000 until 5,000, there will be a consequences. Okay, the consequences will be one of them is raising loan. Okay, you need to increase your loan because sometimes you need money to come out with the capital, and then you want to rolling your capital in order to run the business, and then after you run the business you expect that you will get a revenue. So even though your target is there, even though the financially the business is growing, that means your your profit is from 2,000 until 5,000, but somehow your loan is increasing. So this is not quite an healthy way of doing the business. Yeah, so that is one of the problem. Okay, I give you another example. Okay, let's say if you want to open a branch. Okay, you have a branch A. Okay, you have a branch A which is let's say your asset is 10,000. Yeah, okay, we're talking about 10,000 asset. And then sometimes I don't know why, probably you feel like you have some greediness, but you want to aim for more. You set up another branch B. All right, and then yeah, in branch B you have 15,000 asset. Okay, so you're expecting that the sales from branch A is in coming, and then the sales from branch B is coming. So that means double sales is there. Yeah, sales increase and sales increase. However, yeah, the question is, yeah, where do you want to get those funding to set up a branch A and B? So therefore, one of the complications there, one of the consequences is sometimes when you have a bigger business, which is growth in business, yeah, so you have to bear loans, yeah, or financing. All right. The more branches that you set up, yeah, the more loans or financing that you have to pay back. That's the problem. Yeah. What happens if let's say branch B is not functioning anymore? Yeah. That means you it's not anymore. So that means even though the business is not running anymore, still you have to pay loan and finance or financing for both branches because you are committed to credit company or finance company or bank. So we're talking this as a grow broke. Yeah, in Malay we call it as macam dah pokai lah, dah pokai, because yeah, you go for big but somehow you need you kind of like borrow more money, yeah, to increase your asset. So it can lead to bankruptcy. Yeah, we've seen so many cases outside there whereby they're going big. Yeah, they're going big. They add more branches, but somehow they cannot survive. Yeah, we see it a lot. Yeah, and then later on that they will close some branches. Yeah, to minimize the debt or minimize the cost. So it can lead to bankruptcy due to high debt leverage. Yeah, so that is one of the big issue happens in the business. At the end of the spectrum, company needs to balance between business growth. Okay, we're talking about business growth and also financial growth. Again, I come back with the example of branch A and branch B. All right. So, at the perspective of business, yes, the business is growing because you add more branches. But the question is, when you have two branches, how about financial? Yeah, are they financially stable or not? Okay, one of them is this is quite risky because those two assets that you have, one of the sources probably comes from loan. Okay, loan and loan. So they need to pay back. So even though business is balanced, growing, but financially you are not. Yeah. So if you are successfully balanced between business growth and financial growth, that means you have two branches and then at the same time you're financially stable, you always get revenue and then you're able to commit the loan, able to pay loan on time, and then sometimes you can have another investor to come in. Okay, that's what we call as a sustainable growth. That means the balance between business and financial. Okay. But they say if business and financial is not stable, okay, that's why we call it as a grow broke. Yeah. So that is one of the issues. Okay. All right. Let's have a look at sustainable growth rate. Okay, sustainable growth rate can be defined as the maximum rate at which a firm can increase sales without raising a new equity. Okay, or increasing its financial leverage. Okay, in other simple words, how do you want to maximize sales? Okay, but no additional fund needed. Okay, so that is the question. If you can achieve a sales maximization without need to add more money, from loan or from equity, that is what we call a sustainable growth rate. That means the business is great already. Yeah. Okay, so that is a sustainable growth rate. Yeah, you're able to achieve sales without come up with more money. Yeah. However, it is different from actual growth rate. Yeah. Okay, this one sustainable and this one is actual growth. Actual growth rate whereby the actual variance between early annual sales only. Okay, it means the difference between sales current year and the last year. Let's say 2020 and you compare with sales 2019. That is the actual growth. Okay, so to measure actual growth is the difference or variance between sales current year and the sales last year. Okay, so at the end of the day, analysts will compare sustainable growth rate versus actual growth rate to see how company can be efficient. Yeah, so in this chapter, after this calculation, we will see this sustainable growth rate is more than actual growth rate, or is that actual growth rate is more than sustainable rate. We will see how it goes. Okay, but before you go to product life cycle, before we go to sustainable versus actual, let's have a look at product life cycle stages. Okay, product also have their life, which is some kind like a human thing, whereby they will go up and then go declining. Okay, let's have a look at the first stage, which is start. Okay, start is here. Okay, this one is start. Okay, start, which is the company loses money while developing product or services and establishing foothold in the market. Okay, why company loses money when the new products come out? Because the cost that come out when they losing the money is come from R&D, research and development. Okay, so they are investing in research and then they are doing prototypes, and then they are designing it and then they're testing it. So lots of course come out. That means it's some kind like more on investment. Okay, so that is a start. Whereby this is the profit. Okay, all right, so the profit will fall first, not fall, but it's not starting first, at the lowest rate. Okay, the second one is rapid growth. Rapid growth is here, RG, rapid growth. Company is profitable, but it is growing so rapidly that is regular infusion of outside financing. At this time, when the product is good and acceptable by the market, consumer will buy more and more and more, and then the sales or profit will be boosting up. This is what we call as a rapid growth. Okay, and at the same time, when this RG phases, don't forget, when the company still having financial commitments need to pay, which is loan. Even though sales is increasing, but they still need to pay loans. Okay, because remember, that's the money that they get from. Not only for loans, but also they need to pay, not pay, but return their equity to shareholders. All right, the third one, maturity. This is a maturity. That means it's a maximum point, whereby declining in growth and the switching from absorbing outside financing to generating more cash and the firm that profitably invest. Okay, at this time, the sales is almost at the peak, and then therefore there's waiting for the time to go down, which is decline. So this is the decline, which is number 4, decline. Company perhaps marginally profitable, generates more cash that is reinvested internally and suffering declining sales. Okay, from this stage until this stage, most of the loan are already paid. So therefore, the loan is decreasing. So if the loan is decreasing, so that customer will still buying more and more and more. So that's why they are collecting cash, without paying loan, or paying less loan. So that's why we call, if the company reaches maturity and decline, so they are able to enjoy cash. But for rapid growth, they cannot enjoy cash much because they need to pay loan and equity. So that is a product life cycle stages. Okay, the firm's sustainable growth rate has its following characteristic. Okay, remember, earlier we talking about sustainable growth rate. That means balancing between business growth, okay, and financial growth. Okay, I repeat again, sustainable growth rate means that you are balancing between business growth and financial growth. Okay, so there are some following characteristics. The first one, it is merely a formalization of the old adage, it takes money to make money. Okay, this is whereby the problem of sustainable growth rate. Like I told you earlier, if you want to add more branches, if you want to add more shops, you need to have money first. Let's say branch A and branch B. Okay, you need those money. But sustainable growth rate means even though you want to add one branch, which is C, you don't need any money anymore, because your money here can transfer, or what we call the revenue that come up from A and B can cover up for C. So that is how a sustainable growth rate means. Even though you want to add another branches, which is D, you don't have to come up with more money. the revenue that from A, B, and C, yeah, can cover D, yeah, without having to add more money. That's why sustainable growth rate is. Yeah, that means they are slowly grow, yeah, and then they will reach a point that they don't have to add more equities or add more financing. Okay, so that is a characteristic of sustainable growth. Okay, the second one, increased sales required more asset of all types, which must be paid for. So again, we're talking about add branches, which is more asset, because branches means building. Yeah, add more building will become add more asset. It's a double asset, yeah, which must be paid. The third one, retain profits and the accompanying new borrowing generates some cash. Yeah, but only limited amount. Unless the company is prepared to sell common stock or borrow excessive amount, the limit puts a ceiling on the growth it can achieve without straining its resources. It is come back to the first one and the second one. Yeah, if you want to go for C, that means yeah, if you want to have sustainable growth, yeah, without adding more money, you need to get maximized sales from the existing asset, yeah, and then you can come up with the new one, yeah. So that is how sustainable growth rate works. Okay, this is the analogy thing about new sales required new assets with asset which must be financed. This one is more on actual growth, not on sustainable growth. Yeah. Okay, so you see here, yeah. If you want to add sales, sometimes you need to add new loans, and then you need to take away the retain profits. Yeah. Okay, so these are the formula, yeah, to compare between sustainable growth rate, yeah, and also actual growth rate. For sustainable growth rate, which is G star, which is equal to P multiplied by R multiplied by A multiplied by T, whereby P is net profit margin, okay, R is retention rate, A is asset turnover, and T is financial leverage. Yeah, so that is a symbol that you need to understand. Yeah, profit margin, retention rate, asset turnover, and financial leverage. For actual growth sales formula, yeah, normal G is equal to sales current year minus sales last year divided by sales last year, yeah, and then multiply by 100. So for those answer will be in percentage, yeah. At the end of the day, multiply by 100. Okay, this one I will come back to you later after I'm done with the calculation. Yeah, see how it goes. Okay, so these are the example. Later on in the slide that you provided in the Google Classroom, you can have a look and see how it works. Yeah, because after this, I'm going to show you on study questions. Okay, before we go for break, any question? Yap and Yanisha. Any question? Okay, how about Yap? No. Okay, if there is no question, we take a 3 minutes break, yeah, and then after that, yeah, we will continue with the calculation part, yeah. Stay tuned, okay, and then I'll be back in 3 minutes. Okay, so let's continue with study question. So I only have two questions here. Okay, question one. Okay, question one. Miss Sally, an investor, needs to analyze the company's growth performance for Medallion Corporation. Below here are the financial information provided. So they give you 2017 and 2018. Of course, this is the current year. And then of course this is the last year. Okay, so this two years information is to calculate actual growth rate later on, and as far as sales is concerned. Okay, you are required to calculate sustainable growth rate. Okay, for sustainable growth rate, you are only involved this one only. Okay, this kind of information. 2017 don't have to, because you need to compare 2018 only. You see, 2018 only. Okay, so therefore, then list three recommendation based on the calculation. Okay. Okay, how to do that? How to do that? Okay, go for it. Which is question one? Okay. Okay, this is quite a short question. Okay, first we need to calculate sustainable growth rate first. Okay, which is G star. Okay, so the formula will be P multiplied by R, P multiplied by R multiplied by A multiplied by T. So I make it the space. So you can. Okay, P multiplied by R multiplied by A multiplied by T. Okay, so after that you need to put the figures. P multiplied by R multiplied by A multiplied by T. Okay, so have a look at this one. Okay, P means profit margin. As you can see here, P means profit margin. So this profit margin, which is 20%. Okay, so I put here 20%. Okay, multiply by R. R means retention rate. For 2018, which is 70. This one G star, I put here 2018. All right. Okay. And then R, for 2018 is 70%. Multiply by A, which is asset turnover in times. So you just put here 2.46 times. Multiply by T, which is financial leverage in times, also 1.90 times. Okay. Done with this one, you need to resolve it. But for this percentage figure, you need to convert into round numbers. Okay, which is 20%. How to get that? 20% divided by 100. You will get 0.2. Multiply by 70%, that means 70 divided by 100, 0.7. Multiply by 2.46 times, multiply by 1.90 times. So what will happen? Yeah, the answer will be 0.2 multiplied by 0.7 multiplied by 2.46 multiplied by 1.90, which is the answer 0.65. Okay, do not forget, yeah, G must be in percentage. So therefore, you need to convert back into percentage, multiply by 100, yeah, which is 65.436, 65.44%. Okay, so you need to convert into percentage, because you see here, the keyword here is growth rate. Yeah, okay, the keyword here is, okay, this one, growth rate. Yeah, so that is a first. Yeah, that is a first answer. All right. After that, actual growth rate. This one. Yeah, actual growth rate. Okay, which is G 2018. It's not a star. G 2018. Okay, the formula will be action S1 minus this one is quite small. I think the best thing is S1 minus S0, yeah, divided by S0 multiplied by 100. That means current year sales minus last year sales divided by last year sales multiplied by 100. So come again with this one. Okay, sales current year, this one. Yeah, this one. Okay, current year 2018, yeah, 1.5 million minus with the last year ones, which is 1 million, divided by the last year 1 million, and then multiply by 100. Okay, so when you press the calculator, the answer will be 1,500,000 minus 1 million divided by 1 million multiplied by 100. So the answer is 50%. Okay, so you got those two answers already, which is sustainable growth rate, yeah, 65.44%, and then actual rate G 2018, yeah, which is 50%. Okay, if you ask me, which one do you want to look, sir? Which one is far better? Is it sustainable growth rate or actual growth rate? I can say that sustainable growth rate is better, because actual growth rate doesn't mean that if sale is growing, that means the financially is growing. This we're talking about the business in terms of sale. Yes, yeah, the business is growing. But in terms of financial, are they financially stable or not? But if you are looking at this one, sustainable growth rate, at the same time sales is growing, business is growing, but financially they are stable. Yeah, the asset turnover are stable, and then the leverage is also stable as well. So this is a we are saying that, yeah, once we compare, we need to interpret and analyze how. Yeah. Okay. So therefore, any question or three recommendation. Okay. Therefore, yeah, sustainable rate, which is 65.44%, is far better than since G star 4% is better than normal G which is 50%. The question asks 3 recommendation. So okay, how to get the recommendation? Let's have a look back at the notes that I given to you. Okay. This one, after calculation, you need to recommend via comparison between sustainable growth rate versus actual growth rate. Okay, as you can see, this is the case of sustainable, which is G star, which value is more than G. And this one, G is more than G star. Okay, earlier when we answer question 1, the sustainable is 65.44%. But for this G, only 50%. So therefore, sustainable is better than actual growth. Okay, so here are the 6 recommendation, but the question asks you to have 3 only. Okay, so the first one, ignore the financial problem. That means if the business is sustained, no need to worry about finance. Yeah, because the revenue that came from the available asset can cover those the additional ones. Additionals. Reducing financial leverage is a good one because they don't have to worry. The business is sustainable, so therefore no need to add more loans. Increase dividend payout. The revenue that get need to you can increase and pay to the shareholders, which is return the money to shareholders. Acquire rapid growth firm. That means it is indicated that the business is growing steadily, yes, and strongly. Okay, and then you are able to cutting prices. That means you can reduce prices. Probably before this, you sell at 3 ringgit. Okay, you can reduce to 2 ringgit without having losses. Okay, but if actual growth is more than sustainable, that means you need to sell new equity. Because even though sales is increasing, but the loan is increasing as well. You need to pay loan as well. So that's why you need add more money. This one you need to add more money. To cater all this financial commitment. Hence, therefore, it will increase leverage as well, which is increase debt. And then therefore, you are not able to increase dividend payout, which is you need to reduce payout. That means you need to reduce the return of profit to shareholders. Next is prune away marginal activities. That means you need to cut costs. That means you need to cut costs. Remove unnecessary expenses. Outsource production. That means you need to sell or assign the task or the main activities to other company. And then increase price. That means let's say 3 ringgit. You have no option, need to increase 4 ringgit. Okay. You have seen so many cases whereby why some of the companies or why some of the products price are increasing. Okay, one of them is inflation. That is one thing. Another thing is most of the company and the production increase their price because they are focusing on sales only, but they are not thinking about business sustainability. In Malay asyik nak untung saja. Tetapi hutang tak mau bayar. Hutang tak mau bayar, that's the problem. So the best thing is this one. Business naik, pada masa yang sama sales pun naik juga. Financial stable. Alright. So don't be surprised if you seen so many products price increases because they are more on this one, which is not a good health for the business. Okay. So let's come back to the question again. Okay, you need to memorize this answer. Okay, since G star is more than G, which is this one, sustainable versus actual growth, you can take any 3 from 6. Okay, the first one, ignore the financial problem. The second one, maybe you can go for cutting prices. And the last one, probably increase dividend payout. Okay, done. Okay, so therefore we are done with question 1. Okay. Right. Let's go for question 2, but this one I just show. Okay, you see the difference, there is no difference between question 2 and question 1. It's a similar pattern. Okay, you still need to calculate sustainable growth and actual growth rate, and then list 3 recommendation. But let's say if actual growth rate is better, answer is better than sustainable growth rate, that means you need to take this one. Yeah, this answer for recommendation. Let's say the answer is other way around. That means your G, yeah, your G here is better than G star. Yeah, so that you need to take this one. Okay. Alright, so we are done with this chapter. This chapter is already finished. Okay, so open to questions.